This lecture is based on CFA Reading 43, which is International Standards Conversion. First, the high-level context. As you have heard over and over through this topic on FRA, that we have two major standards, IFRS and US GAAP. Now, over the years, these two standards are converging, which means that the differences between IFRS and US GAAP are becoming fewer and fewer. But nevertheless, differences still remain, and one of the most annoying things that CFA candidates need to do is understand the differences between IFRS and US GAAP. In this reading, what I'll try to do is highlight the most significant differences. Now, the agenda, essentially this agenda is following the learning objective statements for this reading, which is saying that we'll first talk about the differences between IFRS and US GAAP for balance sheet items, then for income statement items, and finally for cash flow statement items. And then after covering these three areas, we will also look at the impact of the differences between IFRS and US GAAP on commonly used financial ratios. Okay, let's start with balance sheet items. Marketable securities. Now, if you recall from our discussion on marketable securities in an earlier lecture, we can classify marketable securities as trading securities or held to maturity or available for sale. Now, as far as this reading is concerned, I think it is safe to say that both IFRS and US GAAP are fairly similar in terms of the treatment of these three categories of marketable securities. So I think if there's a question on this, the most likely answer will involve the basic knowledge that there isn't really much of a difference between IFRS and US GAAP when it comes to marketable securities. Inventories, on the other hand, there is a substantial difference. IFRS does not allow the last in first out method. US GAAP allows LIFO, and in fact most US companies are going to use the last in first out method because this helps them reduce taxes. And so if you are comparing a US company that is using LIFO for inventory reporting versus a European company that is using the first in first out method, clearly you have to make several adjustments. Since we are talking about inventories, the question is, how do we make adjustments? And the answer is simple. When a company uses the LIFO method, obviously it will report LIFO inventory in the balance sheet, but in the footnotes, that company must also give a number called the LIFO reserve. And when we add LIFO reserve to LIFO inventory, what we get is FIFO inventory. So here is a simple little adjustment if you are comparing a LIFO company with a FIFO company. In terms of property, plant and equipment, what the US GAAP says is that you initially record your fixed assets at historical cost, then every year you subtract depreciation. So the book value of fixed assets at any point is the historical cost less accumulated depreciation. IFRS says that you can do the same. So IFRS core fundamental method again is the same, where you record fixed assets at historical cost less accumulated depreciation. But the difference with IFRS is that it's a little more flexible, so it also allows revaluation in some cases. As an example, if your land is substantially, the value of land is substantially different from what it was when it was initially acquired, you can revalue upwards. US GAAP in general does not allow revaluations. Next, long-term investments. Now, I think that there is a very small chance that you will be tested on this in level 1, because in level 2 this is a major topic. In fact, there is a extremely long reading on long-term investments and intercorporate investments. But nevertheless, I think just the few points that I make here are all that you really need to know. First, just understand what we mean by long-term investment. This is where a company, such as let's say company A, owns a percentage of another company. So if a company owns less than 20%, so let's say a company owns 10%, then the treatment essentially is like owning stocks in that other company. So this is treated like marketable securities that I have already talked about. But what if company A owns say 30% of company B and has significant influence over company B? Then what method do we use to account for this investment? And the answer is equity accounting. In level 2 we will discuss exactly what equity accounting means. Right now just remember that if company A owns 20 to 50% of B and has significant influence, then the accounting method used for this investment is called equity accounting. On the other hand, if company A owns let's say more than 50% of company C, that means that and if this implies that company A has control over company C, then the accounting method that is used is called business combinations method or consolidation method. Effectively what happens in this method is that all the assets and liabilities of company C are reported in a consolidated balance sheet, and then in the equity section we have a segment that's called minority interest, which represents the interest of the minority owner of company C. And finally, joint control. This is let's say between A and D. They set up a joint venture. When they set up a joint venture, the accounting method is either the proportionate consolidation method can be used or the equity method can be used. And all this is according to IFRS. US GAAP is fairly similar, where for significant influence and for control, both IFRS and US GAAP are similar. The only real difference between IFRS and US GAAP comes with joint control or JV entities, where US GAAP says that you must use the equity method, whereas IFRS is more flexible. It allows both proportionate consolidation and the equity method. Now I'm sure you are itching to know exactly what these methods mean, and we will discuss this in level 2. So I'm skipping goodwill because by and large US GAAP and IFRS have a similar treatment. There are some subtle differences, but I really doubt that you will be tested on those subtle differences at level 1. In terms of intangible assets other than goodwill, here we are generally referring to identifiable intangible assets. So these would be things like patents and copyrights and so on. Under US GAAP, these are reported at original cost less amortization. Amortization is simply like depreciation, but this term is used for intangible assets. IFRS generally uses the same method, so we have initial cost less amortization, but as you've seen before, IFRS is more flexible, so it also allows revaluation. Now let's talk about income statement elements or income statement items, beginning with revenue. So there is a general revenue recognition which is fairly similar for both IFRS and US GAAP, so I'm not spending time on that. But when we talk about revenue recognition for long-term construction contracts, then there are some differences. When the outcome of your long-term construction contract can be estimated reliably, then both IFRS and US GAAP use the stage of completion method, which is also called the percentage completion method. So effectively what happens in this method is we recognize revenue based on the percentage of completion. So if in this scenario both IFRS and US GAAP are similar. However, when the outcome cannot be measured or estimated reliably, then there is a difference. IFRS says that you should recognize revenue to the extent that it is probable to recover contract costs. So if in a given year you've incurred contract costs worth 2 million and you are reasonably confident that you will collect revenue at least worth this much, then you can recognize revenue worth 2 million. US GAAP is more rigid. So US GAAP says that you use the completed contract method, where you essentially recognize revenue at the end once the contract is completed. Cost of sales, which is an important item on your income statement. Now, the cost of sales will be different between IFRS and US GAAP companies if the US GAAP company, for example, uses LIFO. As I had mentioned earlier, IFRS does not allow LIFO. So if you are comparing a company that follows IFRS and a company that is following US GAAP, let's say that the company following IFRS is using FIFO accounting and the US GAAP company is using LIFO accounting for inventory. Then obviously, if you are comparing the cost of goods sold, you need to convert the COGS over here into FIFO COGS. And the way we do that is, we say that FIFO COGS is equal to LIFO COGS. So this is the cost of goods sold reported in the income statement of this company, minus the change in the LIFO reserve. So there will be a certain LIFO reserve, let's say 10 million at the start of the year and a LIFO reserve at the end of the year. So you simply take the difference, which is 1. So in general, for companies where sales are growing, inventory is growing, let's say prices are going, then FIFO COGS is going to be less than LIFO COGS, because in that case this LIFO reserve will be growing and we are subtracting a positive number here. But this is what you need to remember. Again, I don't think there will be detailed questions on this, because this topic until last year used to be part of level 1 but now has been moved to level 2. So let's continue with income statement items, and we will now talk about finance costs, which are essentially interest costs. US GAAP requires capitalization of interest costs for assets that take a substantial time to complete. So for example, if you are building a factory which takes 2 years and you've taken out a loan to build that factory, the interest that you pay needs to be capitalized, so it should become part of the factory value according to US GAAP. IFRS says that again you should with IFRS there is more flexibility, so the capitalization of interest cost is optional. This means that if you want, you can capitalize the interest expense the way we do with US GAAP, but not required. As hopefully you can see a pattern here that in general IFRS provides some more flexibility. In terms of non-recurring items, the US GAAP allows what's called extraordinary items, which means items that are both unusual and infrequent. So US GAAP allows them to be reported separately from net income, but IFRS does not allow this. So this is perhaps one of the few places where IFRS takes a more rigid stance, and the logic here being that companies at times can misuse this flexibility that US GAAP allows, and some items that are if a company wants to inflate its net income, then it might pull out items that it defines as extraordinary and report them after net income. IFRS, however, says there is no such thing as extraordinary item, and all expenses need to show up before you calculate your net income. Now we are moving on to cash flow items. So this is fairly important, I think, from an exam perspective. Dividends paid. So this is the dividends that a company pays. So let's say this is company X. It has issued shares, and obviously it needs to make some payments to shareholders. So the dividends that are paid to shareholders, how should they be classified? So this is actual money leaving the company. According to US GAAP, since this is interaction with shareholders, it is treated as cash flow from financing. IFRS, however, says this can be treated both as CFF and or cash flow from operations. Interest paid, so this is when the company has issued a bond or has borrowed money in some other form and needs to pay interest. According to US GAAP, the money that is paid out must be classified as cash flow from operations, whereas IFRS, again more flexible, the money that is paid as interest can be classified either as CFO or CFF. Interest and dividends received, so this is now from investments that a company has made. So either if a company has bought bonds or it has bought shares from another company, then obviously it will receive either interest or dividends. According to US GAAP, all the interest and dividends received must be classified as CFO, whereas under IFRS this money can be classified as either CFO or CFI. And this should be fairly familiar. We have seen this earlier on the reading on the cash flow statement, and since it's appearing multiple times, I think the probability of you being tested on this is relatively high. Now, what is the effect of IFRS and US GAAP? So what's the effect of these differences on ratios? I hope you get this common theme by now, that the analyst must make adjustments before comparing ratios of companies that use IFRS versus companies that use US GAAP. And I would encourage you to study example 5 in the curriculum. It is a long but straightforward example where we have two companies, one follows IFRS, the other follows US GAAP, and we want to compare a few ratios: the net profit margin, financial leverage, current ratio, and the inventory turnover ratio. Now obviously before we can compare these ratios, we need to make adjustments, and one of the most common adjustments that needs to be made when comparing IFRS and US GAAP is the adjustments to inventory. And since the example in the reading talks about this adjustment, and then there are problems at the back that also talk about this adjustment, I think that's a clue that maybe this is a higher probability question on the exam. So we've already talked about this. I'm just putting things together that when we talk about comparing net profit margin, obviously we need to make adjustments to the COGS. So the simple thing to do would be to take the LIFO COGS that's reported for the company using US GAAP. We see what was the change in LIFO reserve and come up with FIFO COGS. So we'll need to use that when we come up with profit margins. When we come up with current ratio, obviously we need inventory numbers. So again, to convert the inventory of the US GAAP company into a FIFO equivalent, we should take the inventory reported in the balance sheet of the US company and add the LIFO reserve. So then we'll have a number that is comparable with the FIFO company. Hopefully that makes sense, but the core message essentially is make adjustments before comparing ratios. So that is it. Hopefully this was a fairly straightforward reading because you have seen most of this material before. Practice hard. There are several good questions in the curriculum. If you have any comments, please post them, and if you like this video, please click on the like button.